Welcome to the Explainer. So let's unpack one of the most fascinating things happening across the financial landscape right now. Just picture the current market in 2026. You've got wild swings, those massive AI hype cycles completely resetting, and a whole lot of investors just white-knuckling their way through intense volatility or, super risky crypto plays. There are a lot of red portfolios out there right now, and it's causing some serious anxiety. But right in the middle of all this chaos, there's this one surprisingly boring ETF that is quietly absorbing billions of dollars and completely dominating the conversation. Literally no meme stock energy, no parabolic midnight spikes, just relentless consistency and powerful dividends. We're talking about SCHD. It's the dividend ETF that has suddenly taken over finance YouTube, TikTok, and basically countless investing communities. But why? What is actually driving this massive influx of capital into such a traditional fund? Let's figure out if the reality actually matches the internet hype. Now, if you spend any time scrolling through financial media right now, you might get the impression that this fund is some sort of magic lottery ticket. But to truly understand its power, we've got to strip away that illusion right out of the gate. This quote really hits the nail on the head. SCHD was never designed to make people rich overnight. You see, human nature constantly pushes us to chase the fastest possible return, right? We want to find that one hidden stock that goes up 1,000% in a week. But that approach usually just leads to getting burned. This fund, it was explicitly engineered to build real wealth slowly, safely, and consistently. And when we look closely at today's highly unpredictable market, we actually begin to uncover exactly why that methodical, slow and steady strategy is proving to be mathematically superior. Okay, let's dive into this. We're going to cover the boring ETF phenomenon, SCHD's secret success formula, the power of compounding, how SCHD stacks up against savings accounts, and finally, the balanced portfolio reality.
So, Part 1, the boring ETF phenomenon and exactly why SCHD is exploding in 2026.
To really understand this explosion in popularity, we have to look at the broader macroeconomic backdrop. High-growth tech stocks are currently wrestling with some severe valuation pullbacks. Investors who were riding high on future promises, well, suddenly they're demanding current profitability. And that is exactly where SCHD steps in. It's outperforming major indexes by anchoring itself to four absolutely unshakable pillars: strong cash flow, reliable dividends, financially healthy companies, and long-term stability. Now, amateur investors often completely ignore these fundamentals during euphoric bull markets, but institutions for sure do not. Look, what strong cash flow actually means in practice is that a company has real money in the bank to weather economic storms, pay down debt, and still cut a check to its shareholders. So instead of trying to guess which volatile startup is going to invent the next big thing, this strategy focuses your capital entirely on battle-tested American companies that have decades of proven resilience. And when we break down the fundamental DNA of this fund, we find a heavy concentration in 5 specific sectors: healthcare, consumer staples, energy, financials, and industrials. Notice what isn't heavily represented here. You won't find speculative software companies or unproven virtual reality startups. These slices, they represent the absolute bedrock of the economy. They're the everyday essential businesses that society just functions on. Think about it. Whether the stock market is up 20% or down 20%, people still absolutely need their prescription medications. They still buy household goods like toothpaste and detergent, and they definitely still pay their utility bills to keep the lights on. That built-in, unglamorous reliability acts like a massive financial shock absorber, and it's precisely why Intelligent Capital is actively seeking shelter in these sectors right now. Moving right along to Part 2, SCHD's secret success formula, taking us beyond just high yields. Look, there is absolutely no shortage of dividend funds out there in the market. In fact, a lot of them purposefully try to lure you in by flashing these massive 10 or 12% yields. But in finance, an artificially high yield is usually a trap. It almost always means the underlying stock price has collapsed and a really painful dividend cut is right around the corner. Well, SCHD totally bypasses this trap by acting like an incredibly strict bouncer at an exclusive club. Before a company can even be considered for this fund, it must pass a rigorous screening process. We are talking about a mandatory 10-year history of dividend growth consistency, a highly efficient return on equity, really healthy cash flow to actual debt ratios, and incredibly sustainable debt levels. By demanding these exact metrics, the fund actively filters out businesses that are taking on toxic debt just to pretend they're generous with their dividend payouts. It's this unwavering quality-first approach that separates the real wealth generators from those super dangerous yield traps. But having a fantastic screening mechanism is really only half the battle. The other major factor driving this fund's success is its incredibly low expense ratio. Now, this might seem like a totally minor detail, but it is actually one of the most critical components of long-term wealth building. A lot of actively managed mutual funds will charge you upwards of 0.75% or even a full 1% annually. SCHD operates at just a fraction of that, sitting right around 0.06%. When we run the math on that difference over a 20 or 30-year investing timeline, a high fee can literally devour tens of thousands of dollars of your potential returns. By stripping away those exorbitant management costs, the compounding engine becomes exponentially more efficient. It basically ensures that the vast majority of the profits stay exactly where they belong, right in your pocket.
Which brings us to part 3, the power of compounding, where we'll be visualizing the math. Now, this is where the strategy evolves from merely being a safe haven into an absolute unstoppable wealth-generating machine. Let's walk through a highly realistic journey over a 10 to 20-year horizon, and this brilliantly illustrates the whole concept. Step 1, you make a foundational $10,000 upfront investment. Step 2, you add a disciplined $300 every single month. And step 3, which is honestly where the true magic happens, you religiously reinvest every single dividend back into the fund to buy more shares. What makes this so incredibly powerful is the psychological benefit. You're not day trading, you aren't losing sleep trying to time the bottom of a market crash. You are simply stepping back and letting the sheer force of compound interest do the heavy lifting for you. Month after month, year after year, your growing share count produces even more dividends, which in turn buys even more shares. It creates this massive snowball effect that just accelerates over time.
By following that discipline system, you're essentially unlocking a 4-pronged attack on wealth building. First off, you receive those standard quarterly dividend payments. But the second point, dividend growth, is the real secret weapon here. Because SCHD only selects companies that consistently increase their payouts, your personal yield on your original investment actually grows year after year. It is literally the equivalent of getting a raise at your job without ever having to ask your boss. Combine that rising income stream with the potential price appreciation of the underlying ETF and supercharge the whole shebang with long-term reinvestment compounding, and the results are frankly staggering. You are quite literally getting paid to be patient, accumulating more assets regardless of what the broader stock market happens to be doing on any given Tuesday.
All right, part 4, SCHD versus savings accounts and the rotation of capital.
To fully grasp this entire phenomenon, we have to contextualize it within the current macroeconomic environment. Think back to just a couple of years ago. High-yield savings accounts were the undisputed kings of the risk-free return, right? Easily offering 5% or more. But as central banks pivot and interest rates begin their inevitable decline, the math on those savings accounts is rapidly deteriorating. Investors who just park their cash are watching their monthly interest payouts shrink. So the big question is, where does all that capital go? Well, it rotates. It seeks out a new vehicle that offers stability but crucially outpaces inflation. And SCHD provides exactly that bridge. It offers a growing dividend income that typically scales with or beats inflation, right alongside the long-term appreciation of the principal investment. It represents the perfect landing zone for folks who are finally realizing that holding too much cash in a declining rate environment is pretty much a guaranteed way to lose your purchasing power.
That brings us to our final section, Part 5, the balanced portfolio reality and the missing context.
Okay, here comes the reality check that a lot of influencers probably won't tell you. When we dig into the full picture of portfolio construction, we uncover a really crucial reality. SCHD is not a silver bullet. During a raging tech-fueled bull market where money is practically free, growth funds will almost certainly outperform a conservative dividend strategy. That's just a fact. You kind of have to think of investing like a mechanic's tool belt. You wouldn't use a hammer to tighten a bolt, and you definitely shouldn't use a dividend fund when your primary goal is aggressive, high-risk growth. A truly sophisticated portfolio assigns very specific jobs to different assets. Growth stocks handle your aggressive upside, broad market ETFs provide the core foundational exposure to the entire economy, and SCHD, it serves a highly specific function, providing ironclad stability and generating reliable, growing cash flow. By intelligently mixing these elements, you can confidently capture the upside of market rallies while still having a fortress of dividend income to protect you when the next recession inevitably hits. Ultimately, this deep understanding of balance is exactly what creates truly sustainable long-term wealth. The massive popularity of SCHD in 2026 isn't some weird fluke, and it certainly isn't a speculative bubble. It's the direct result of millions of investors waking up to a highly disciplined strategy. It's a collective realization that, hey, chasing the next hot trend is exhausting, but owning a piece of highly profitable, cash-generating businesses is incredibly empowering. While day traders are glued to their monitors, stressing over 5-minute chart fluctuations, dividend growth investors are playing an entirely different game. They're focused on peace of mind. They're steadily expanding their passive income stream, and they are quietly building generational financial freedom, literally one single dividend payment at a time. Sometimes the unglamorous, methodical approach is exactly what wins the marathon. Which leaves us with a pretty compelling final thought to consider. In a market utterly obsessed with hype, manic volatility, and the illusion of overnight riches, is boring actually your smartest strategy? Definitely something to think about as you navigate your own financial journey. Thanks so much for exploring this with us today.